thing you're looking for is the second paragraph. In our opinion, the statements referred to above in all material respects, blah, blah, blah. That is your clean opinion. You have successfully achieved another clean opinion. Mr. Zachary had wondered if this would be the year, and I don't, there's nothing in this statement that I can't think you're not getting off that list. So, certainly, there's a big argument to get off that list. Let's go. I'm going to start over at Exhibit 1, which for you will be on page 17. The difference between page 17 and page 19, page 17 is what we call the full accrual-based accounting. Page 17 encompasses all of the hard assets, the buildings, the land of the town, plus your pension situation. And for you, like every other town, your pension liability went like this. And the reason is, it's based on evaluation for the year before. And what happened in 22? The market tanked, especially late in the year. So your pension liability went up nearly $550,000. Take that in conjunction with the law enforcement separation increase in liability, you saw a massive increase in your pension liability. Now that's not an all dollar for dollar expense to the town. There are a bunch of components built in, which I'll highlight here in a moment. But what's going to happen June 30, 2024? Well, I don't know. We're at 35,000 down now, so you might just have this humongous reverse swing again. The thing about this number is it comes from the North Carolina Treasurer. They are the ones who hire the actuarials. They're the ones who put together, for all 552 municipalities, they say, here it is. And this is the expense you have to recognize, and this is what your pension liability is. So it's 100% out of your control. You grow your payroll, the liability goes up. You shrink your payroll, it goes down, just like any other business. But for this year, and I'll highlight where that is going to show up for you. But if we're looking at the statement on page 17, the real important number at the very top, about 10 rows down, total current assets, you have $1.7 million at June 30, 23. 1.3 of that is cash. So balance sheet is a historical look back in time. At June 30, you had $1.3 million of cash. You had $50,000 of current liabilities. Those are bills that came in July and August for last year. And your total liabilities, even including the pension liability, which isn't really something you have to go pay for, your cash on hand exceeded all of the liabilities of the town. And that's what I was referring to as this is quite the great little story to tell. You had a very successful year. I'm going to highlight that real quick. We're going to go to Exhibit 5, which will be over on page 23. When you had budgeted your year, you had expected 2.6 of revenue, 3.1 of expenses. So you had budgeted that you might be eating into your fund balance for the fiscal year 2023. Well, look what really happened. Your revenues went to $2.8 million. Your expenses, $2 million. So you had dropped $1 million off your budgeted expenses, and the town had a profit of $800,000 for the year. So what did you do with that money? Well, you paid off your debt. You paid $418,000 off and paid off your debt, and increased your cash by $500,000. So it's pretty good. It's pretty strong. We go back to page 17. Sort of about 3/4 of the way down, there's a section called long-term liabilities. And if you keep your finger on that and you go back to page 14, you're going to see you started the year with close to $800,000 in long-term liabilities. And even though your pension liabilities went up, as you can see, by almost $850,000, you dropped your debt by $418,000, so that mitigated almost half of that increase. That was not an increase that you have any control over. So if you're back to page 17, at the end of the year, June 30, 2023, you have at the very bottom row a net position of $3 million. Now think of that, people who know that, the for-profit world, think of that as the town's equity. We have $3 million. But you can't spend all that, because a whole bunch is reserved for fixed assets, and then a whole bunch gets reserved for the reserve for state stabilization. This is something from the Depression. It's a big reason why the state has a 4A bond rating, because all 552 towns have to have an annual audit, and they have to have a computation of a minimum reserve so that the town stays afloat. So at the end of the day, that next to the last row, that's the town's free money to spend, $670,000. Okay. Any questions on the balance sheet? Okay. Let's go to the next page. This is what we call the full throttle income statement, full accrual basis. This includes the hit for the pension. The actual pension expense that hit your books was just shy of $300,000. This includes depreciation expense, which your number for the year was $174,000. But as we saw, the revenues increased. More importantly, your expenses decreased dramatically over what you had budgeted. And you go to the third row from the bottom, and at the end of the day, you have almost $900,000 net positive for the fiscal year. If you go up about 8 or 9 rows, your property taxes for the year, $1,359,000. That was very close to what you had budgeted, and we'll see that shortly. Other taxes, well, you got $700,000 of ARP money. So that number, you also increased your sales tax pretty good too, but that number, you won't have that ARP money going forward. You're not alone. Every other town got it. They got the 2 swatches like you. And but that's what makes that number maybe look a little bit inflated. The far right column you saw on the last statement and on this statement, the ABC board, that's called a component unit. Its results of operations, its assets and liabilities are shown. This is what we call a memo. It's basically shown as, hey, we're related to this unit. It kicks us over $100,000 this year, and because we're related to them, we have to show their details. But those balances do not factor in to everything I'm talking about here today. Your balance sheet, they do not factor into your income statement. All right, go to page 19. $19 is the balance sheet on the government accounting. So what's different from over on page 17 is there are no fixed assets on the schedule, and there are no pension liabilities of any kind. This is your straight up, think of it as like a cash basis. We took, what cash do we have available to spend? Well, we have that $1.3 million of cash. We have taxes receivable to come in. That's money that actually came in within 60 days of this year end. We have garbage billing to collect, due from other governments. That is mostly sales tax. Sales tax that came in July, some of August. That was for the fiscal year ended June 30, 2023. You say, Joe, how do you audit that? Well, we looked at the cash receipt. We looked at the deposit. Pretty much anything on the balance sheet, the way we audit is we're going to look at it substantively. I'm going to look at actual statements. I'm going to look at actual deposits. I'm gonna go look at the checks you wrote in July and August and say, did you put them in the right period? So this stuff is, we've looked at pretty much most everything on here from an audit standpoint. On a government accounting standpoint, you've got $1.2 million, second row up, third row up from the bottom, of what's called unassigned fund balance. And that is what Mr. Zachary is looking to build, because that is where you can do all the great things you've been doing around here. You can continue to do that with that money. You asked, Joe, why is the ARP, why is that column 0? Well, because you spent it. You got the money in. Last year's audit, it had money in it. It had money in cash, and it was called deferred revenue, meaning we hadn't quite figured out what we're going to spend it on, but you made it. You've used it for revenue replacement. You've used it like you were allowed to. And when you got the second swatch, $714,000, you'll see on the 2 pages, on page 21, you'll see that money being reported as income and being utilized. Page 21 is the income statement on a government standpoint. Again, no pension, no depreciation expense, nothing to do with hard assets. If you have that page open and you look at the very next page, page 22, page 22 looks confusing. It's a reconciliation of basically statement 18 and statement 21. It says, how did we get, what's so different between government accounting and full-blown accrual accounting? And you can see depreciation expense is not part of the government accounting. In the last row, the pension expense, not part of the government accounting, but nor is the debt payoff. So if you look at the very top row and you look at the very bottom row, for your year, 23, there's really not much of a difference between full-blown accounting net income and your government accounting. If you hadn't paid that debt off, it would be much different, because you wouldn't have that $400,000 add back to this income. Any questions on the income statement? Okay. We can go into the notes. The statements are huge. Basically, page 28 through 29. These aren't any magic that I do. The NC Treasurer has model financial statements for a town, for a county. This is what they want. This is why they all look the same. And this is why when I remit your audit, there's a big Excel sheet that I populate with cash balances and fixed assets and liabilities or this or that, and then they can roll all that up into some jumbo Excel sheet that they have a dashboard on. When that dashboard from year over year shows a red ratio on it, then you get a phone call or a letter. We don't have any of those this year, so that's good. Let's go over to page 30. Page 30 tells you the historical amounts of your hard assets. So the top half, that represents the actual cost you pay to purchase all those assets, whether it's this podium, chair, the table, a building improvements, the land. That's the top half. The bottom half is the lifetime depreciation. So you buy a computer, we amortize it 5 years. You buy a building, we're going to amortize that for 40 years. And you can see right in the middle, there's a column that says increase. That $174,000, that's your depreciation expense for the year. And each of those 4 categories of assets have a different life, a useful life. The building, of course, has a much more useful life than your vehicles or computers or equipment or furnishings. The next page over, you'll see there's also a fixed asset listing, and that's for the ABC unit. It's completely meaningless to your governance of the town, but it's required to be here. The one page that's really interesting, let's go over to page 37. Well, as you're flipping through, all those pages there that are related to the pension, again, all that's spoon-fed from NC Treasurer, those target allocations of assets, that's the state treasurer, what they've allocated to invest the pension money in, the growth rates, all that, that's all stuff the state's actuaries use to come up and say, well, you owe your pension liability $700,000. That's all required disclosures in a GAAP financial statement, which yours is. You could go to the state treasurer's website, you could click on financial statement resources, you can click on municipalities, and all these are going to just be right there. There's nothing magical that I do. But go over to page 37. On your balance sheet, on the full-blown accrual, you've got these weird words, deferred inflows of resources, deferred outflows of resources. They're almost, for those who know these things, almost like a prepaid expense. Like something that's going to turn around later. Maybe for the good, maybe for the worse. But if you look at those three middle rows, differences between expected and actual experience. Well, we expected to get 4% on our money. That didn't happen. So if that didn't happen, so guess what? In the accounting theoretical world, you, Franklinton, would have to pony up $700,000 to cover everyone's pension if they all theoretically retired today, and this is the bucket of money we had to pull from. That's sort of the theory around these deferred inflows and outflows. And that's a lot of math. I'm aware of that. Okay. When you look over at pages 40, 41, 42, 43, these are again required because of your pension. And interesting, page 41 is kind of interesting. I always think, wherever I go, I think this one's interesting. You can see in the third row, your covered payroll. 8 years. Look how it's grown. Look how it's shot up. Now that doesn't necessarily, it does mean you've hired more people, but if you compare 2015 to 2023, well, what's had to happen? Well, we had to pay more money to get people. We had to pay more money to keep them. So your covered payroll, I just don't see that ever going down in the foreseeable, especially a town like yours that's really growing and blossoming. But you can see how your pension expense just, that's how it is. And then your number was high again in 21. As we know, 2020 wasn't your best year in the market either.